Hello and welcome to Unacademy, a one-stop destination for all the English medium civil service aspirants. Welcome to another session of Economy Weekly Recap, wherein we take all the important economy-related articles which have appeared in different business-related newspapers and will be analyzing these articles. And for this session, these are the list of 6 important articles or the concepts that you should understand. Now, before I start the discussion, a very important announcement. We at Unacademy have launched an English online classroom program. The program has started very recently from April 6th, a new batch. The faculties who are taking the classes will be Sarma sir, myself, Abhishek sir, Himabindu ma'am, Chetan sir, Mukesh sir and Astha ma'am. If you're interested, please call on this number, and for further details, a link is provided in the description below. Click on the link. Let's start the discussion. The first very important article, which appeared in Mint newspaper on 2nd of April, is related to foreign investments that are flowing into India and what is the likely impact in various parameters within financial market and overall Indian economy. Let's understand the basics first here. In the last 1.5 years, there has been a lot of discussion regarding inclusion of the bonds from India, the bonds from the financial market in India in the global index or global indices. For example, there are various global bond indices such as Bloomberg, the JP Morgan, FTSE Russell, etc., who have already announced that they would be including the bonds from India in their bond indices. Now, some of you might be thinking, sir, what is the implication? Why should I study this article? Is it relevant? More importantly, for the civil services. Point number 1. With inclusion of the Indian bonds in the global bond indices, specifically in the article they are discussing the government bonds. Why government bonds? Reserve Bank of India from 2020 introduced a new type of investment route by the name of fully accessible route, FAR, fully accessible route. Under the fully accessible route, certain government securities, government bonds were identified, and whatever restrictions were imposed on the foreign investors investing only on these government bonds, relaxations were provided. The whole idea is that if you provide these relaxations, more and more foreign investments will flow into these bonds which are covered under fully accessible route. Now, before I go forward, I have a very simple question. Please check this out and do let me know if you know the answer to this. Are sovereign green bonds, are the sovereign green bonds part of fully accessible route? Please do let me know the answer to this question in the comment section. So, point number 1, fully accessible route. We expected a lot of investments to come into these particular government bonds. And who will identify these bonds which are part of FAR? Reserve Bank of India. And whenever such reforms are implemented, obviously we expect a lot of investments to flow into such instruments in the financial market. So, various global bond index providers have looked at the reforms or the measures implemented by RBI as well as Government of India, and they are of the opinion that, okay, these reforms will attract a lot of investments. Government is opening up the market. They are providing for more convertibility, specifically under the capital market. And as a result of this, these government bonds which are part of FAR are being covered in many of these global index providers. Now, with inclusion into these global indices, we will attract a lot of investments. The foreign investors which track, the passive investors who will track these global bond indices, they will automatically be interested and start investing in such instruments which are part of India's financial market. With the announcement of many of these index providers, already the article says more than 78,000 crore rupees. I'll repeat it. More than 78,000 crore rupees worth of investments to the extent of around $9.4 billion have already flown into these bonds or these instruments in Indian financial market. And the argument is, with these kinds of announcements as well as inclusion, the total investment by mid-2025, I repeat, by mid-2025 will be around $25 billion. Around $25 billion. To that particular extent, we are expecting investment flows to happen into the financial market. Now, if these investments are going to flow into India, what is the impact of it? And that is what is being discussed in the article here. And I feel UPSC might pick up a question in the application part of it. Now, what are the implications? Have a look at this. Point number 1. If more and more foreign investors will be interested in the bond market, will bring in a lot of dollars into India, can I simply say inflow of dollars will start increasing. This is a natural outcome. And if inflow of dollars will start increasing, automatically more and more dollars will be sold in the forex market. Demand for rupees will start increasing. And in this particular situation, RBI will come into the market to stabilize the value, stabilize the exchange rate. And that is the second very important point. RBI's role will also increase here. RBI has to play a very important role in stabilizing the rupee versus dollar or dollar versus rupee exchange rate. And has it happened in recent times? Of course, yes. And that is the second application. Remember this. Very recently, in multiple newspapers, you might have come across one article where they are saying the amount of forex reserves held by RBI have increased to record high of more than $640 billion. More than $640 billion. One of the reasons why the forex reserves of Reserve Bank of India have increased is the investment flows. With more and more dollars coming in, the supply of dollar increases, demand for rupee also increases. RBI has entered into the market, sold more rupees and purchased a lot of these dollars. In fact, since February this year, calendar year mind you, since February this year, RBI is said to have purchased more than $20 billion from the forex market itself. And that is adding to the forex kitty held by Reserve Bank of India. Point number 3, with more investments coming into India and demanding more and more of government bonds, what we can expect is the yield rate of government bonds will start going down. And if you're wondering, sir, what is this idea of a yield rate? How it is connected? Logic is simple. Yield rate basically talks about the rate of returns. The returns that an instrument will provide to an investor is called as an yield rate. And simply remember the formula. The market price and yield rate both are inversely related. Both will move in opposite direction. And in this case, more money will come. They will demand more of government bonds. Demand increases means market price will increase. And on the other side, yield rate will start decreasing. So yield rate will be affected. Yield rate will start going down. And with the lower yield rate, now corporates, mind you, corporates, because please understand this, the yield rate on government securities is generally used to price the coupon rate on corporate bonds. So with the lower yield rates, even the coupon rates or let's say interest rates on the corporate bonds will become lower. Companies can borrow from the market at lower interest rate. With the lower yield rate, even now government can go to the market, issue bonds at lower coupon rate and borrow from the market. So these are the 5 very important advantages of more and more investments coming into India because of the announcement of inclusion of government bonds into the global index providers or global indices. Now, based on this discussion, I have given an MCQ. Consider the following statements regarding fully accessible route, FAR. Let's start. The route is available only for the FPIs and not available for the NRIs. First statement is wrong. Why? Please remember this. This route is available for FPIs, foreign portfolio investors. This route is available for NRIs as well. So first statement is wrong. Under this route, the investments can be done in all the government securities. Again, second statement is also wrong. Why? only those government securities which are notified by Reserve Bank of India will come under FAR. It has come into force from 2020. Statement 3 is correct. So first and 2 are wrong. Third statement is correct. Which one of the above statements is or are true? Right? Or how many of them are true? Only one. Right option is only one. Only one of the 3 statements are true here. Let me go to the next article. Government appoints new presiding officer for Securities Appellate Tribunal. Now, what is this idea of a Security Appellate Tribunal? Why it is relevant? Is it needed for UPSC examination? Let's start. Securities Appellate Tribunal, please understand, is established under SEBI Act, Securities Exchange Board of India Act of 1992. Under section 15, we have established Securities Appellate Tribunal. Now, when it was originally established, the role was, if SEBI will issue an order, if SEBI issues an order, the investors against a company, etc. Now, somebody has to be there where these other parties can approach and appeal against the order of SEBI. Very simple idea. If there are 2 parties and one party wants to appeal against the order, there should be an appellate authority. So, looking at this requirement, Government of India announced establishment of Securities Appellate Tribunal. But over a period of time, the scope of SAT's functioning was expanded by the government, and SAT post 14 and 15 in India has started hearing appeals against PFRDA, Pension Fund Regulatory Development Authority, IRDA, Insurance Regulatory Development Authority. So today if you ask me, so SAT will hear appeals against whom? It will hear appeals against SEBI, IRDAI and PFRDA. Now point number 2, SEBI has only one bench. It is set up in Mumbai, only one bench. And the composition of SAT is simple. There are 3 members. In the SAT, there are 3 members. And these 3 members, basically out of this, one has to be a judicial member. One has to be a judicial member. And when I say judicial member, the Government of India dictates or says that this judicial member has to be a retired judge of a Supreme Court or a Chief Justice of a High Court. So that is one judicial member, and there has to be one more technical member. There has to be one more technical member. What is the importance of a technical member? SAT will hear appeals against SEBI or PFRDA or IRDA. Now you need to have certain member who knows how the market is actually operating. If a judicial member wants to get certain assistance, wants to understand and issue an order, there should be a technical member to provide assistance to explain how the market actually operates. So one is a judicial member and the other one is a technical member. Point number 3, whenever you have an order issued, the order has to be issued only by the judicial member. Technical member is not allowed to issue orders. Now what has happened? Listen to the story. Out of 3 members, 2 members have retired. Their tenure is over, they have retired. And in the year 2023, more than 1,000 cases were taken, 1,000 appeals were done at Securities Appellate Tribunal. And out of this, more than 750 cases are still pending. At the end of the year, more than 750 cases were still pending. And the reason, and this is not the first time that there is a vacancy. I repeat, this is not the first time that there is a vacancy in the Securities Appellate Tribunal. Even back in the year 21 and 22, there was no technical member. And when there is no technical member, how can you expect a judicial member to issue orders having understood how the market operates? And that is where SEBI basically argued against this absence of a technical member. And what has happened in the recent past is, because there is no judicial member, there is no one technical member, the remaining one person has kept on adjourning the cases, which meant that there are a lot of cases where there is a backlog. More and more cases are getting filed, but these are not getting resolved. And looking at this, there were multiple articles in the newspapers regarding why there is a backlog in the Securities Appellate Tribunal. Because SEBI, the most important regulatory authority in India, specifically targeting the market, the financial market. So when there are a lot of orders issued by SEBI, there should be one more authority to appeal against these orders. So that appeals mechanism was lagging behind. So Government of India very recently has announced that a new presiding officer has been appointed and a technical member also has been appointed. For example, have a look at the name here, P.S. Dinesh Kumar, former Chief Justice of Karnataka High Court, and Dheeraj Bhatnagar, retired Principal Chief Commissioner of IT Delhi, has been appointed as a technical member. So these are certain important points regarding the concept of Securities Appellate Tribunal. Now based on this, I have given an MCQ. Let's start. Consider the following statements regarding Securities Appellate Tribunal. It is a constitutional authority. Absolutely no. It has only one bench. Yes, it is correct. It hears appeals against SEBI, PFRDA and IRDAI. Yes, second statement and third statements are true. How many of the statements are true? Right option will be option B. Only two of the statements are correct. Let me go to the next article. Small finance banks want to peel off the label of small. Now, what is the basic idea? Listen to the story here. Reserve Bank of India, in order to promote financial inclusion, I repeat, RBI, in order to promote financial inclusion, started promoting two different types of banking models in India. Differentiated banks or niche banks. One of them is small finance bank and the other one is payment bank. Now the discussion is regarding small finance bank and let's be focused upon it. The small finance bank as a model was basically introduced by Reserve Bank of India in order to promote financial inclusion. And back in the year 2015, Reserve Bank of India started issuing licenses for many entities to operate as small finance bank. Initially 10 entities were given license and over a period of time 12 entities were given a license. And out of 12 today, 11 are operating. It's not because one more has shut down. It is only because two of the entities have merged. And as a result of this, right now there are 11 small finance banks which are operating in India. But to the point here, why the small finance banks are approaching Reserve Bank of India? And again, much more to the point, has RBI accepted this request of the SFBs to drop the term label, to remove the term small from their labeling? RBI very recently in the concluded monetary policy review meeting has not accepted it. But what are the points? What are the concerns raised by the SFBs? Three very important points here. SFBs are saying we are being held back. We are not able to collect more and more deposits. We are being held back because of the term small in the name of the bank. That is, if you observe any of these particular banks, specifically SFBs I am talking about here, in the board of these banks, they will have to mention that they are small finance bank and that it has to be mentioned in the name itself. For example, SFBs such as Ujjivan, right? They will mention this as Ujjivan Small Bank. Right? AU, Small Finance Bank. So the term small has to be mentioned in the board itself. And the concern that these banks have raised is the term small is not associated with the type of work we do. It is not associated with how much deposits we are collecting. The term small has been mandated by Reserve Bank of India to showcase the fact that the SFBs will have to target small borrowers in the market. And what do you mean by small borrowers in the market? In case of SFBs, the functioning of SFBs, RBI simply says there will be a priority sector lending PSL target of 75%. They will have to meet a PSL target of 75%. Not just that. More than 50% of the loans that they provide, will have to be of a value up to 25 lakh rupees. So the target borrowers for these kind of banks is the smaller borrowers. Right? These kind of borrowers are either not covered correctly or not covered satisfactorily with the other banking sector units in India. And that is the reason RBI says mention the name small or mention the word small in the full name, and it should be there in the board as well. But the banks basically counter argue that if I put the term small in the name, many of the customers might be basically misunderstanding the term small there. They might simply feel that the bank is very small, its deposits are very small, and that is the reason the banks are saying, that is the SFBs are saying, we are not able to collect more and more deposits. We are not able to collect more and more current accounts and savings account deposits. That is point number one. Point number two, can there be certain relaxation? Can there be certain relaxation provided to us regarding the PSL number? Can you provide us with certain relaxation? Why? In case of small finance banks, the PSL target is 75%. Whereas in case of other scheduled commercial banks, the target is 40%. And when you have to keep more and more loans under PSL tag, under the PSL label, it simply means the loans available for other opportunities, other lending activities is limited. So revenue potential will also become limited. So the argument is simple. Can you provide us more relaxation under the PSL criteria? So far, nothing has been given or no relaxation has been announced by Reserve Bank of India. Point number three, the third concern raised by them is, can we become a universal bank? Can we become a universal bank? Please understand this. Right now, RBI follows a policy called as on-tap license. What is the basic idea for on-tap license? At any point of time, you can approach RBI, apply for a license. RBI will consider whether to give you a license or not. RBI will decide whether to give a license or not to you to operate as a bank in India. So many of these small finance banks which started operating back in the year 2016, 2017, they are saying, can you please give us a roadmap? Can you give us a glide path so that we will become a universal bank? And if you're wondering, sir, what is the benefit of becoming a universal bank? Please understand this. Whenever you talk about a differentiated bank or a niche bank, the activities, the areas that they are allowed to operate in, there are certain restrictions over that. Whereas in case of universal banks, you can take up any of the functions. It could be a primary function of a bank or secondary function of a bank. So universal banks will have a large scope of activities to perform and revenue to generate compared to a differentiated bank or a niche bank. So the third demand or the third request that they have done to Reserve Bank of India is basically provide us with a glide path. Provide us with glide path so that we will become a universal bank. We'll get a license for universal banking later. And as such, when RBI promoted the model of the small finance banks, initially only one condition has been imposed. To apply for a universal banking license, you are just supposed to have a working experience of 5 years. Complete 5 years as a small finance bank, then we will consider to provide license for universal banking. So these banks are demanding, or they are asking that, show me, right, or let me know how do I apply for it? What procedure should I follow? Are there any conditions that you want me to abide by to become a universal bank? So these are the three very important things that are being discussed in the context of small finance banks. In fact, one more point I just want to add here. The small finance banks, when they approached RBI regarding the first request, they said, can you give us an exemption like you provide to cooperative banks in India? What is the exemption, or what is the application of this concept of naming in case of cooperative banks? Cooperative banks are allowed to use their name, and below in a line they will mention that they are a cooperative bank. So what these small finance banks also demanded or requested was the same thing. Can you also allow us to write the name without using the term there, that is a term of small, and below the name can we write that it's a small finance bank? And RBI has not accepted this request so far. Now these are certain important things. Let me go to the next article. There are two articles which have appeared in different newspapers regarding electric vehicles, EVs, electric vehicles. The first article is discussing regarding the GST rate. Second article regarding the new initiative, that is electronic mobility promotion scheme which has come into force from the 1st April 2024. Let's start with the first article here. The electric vehicles or the manufacturers are citing disparity and they are demanding GST reforms. Now, what is the disparity they are talking about? Please understand, whenever you talk about goods and services tax, GST, there is one issue which is plaguing many of these participants, or let's say the manufacturers or sellers in Indian market. That is basically the problem of inverted duty structure. Inverted duty structure. And what is the basic idea for inverted duty structure? Under inverted duty structure, compared to the normal situation, I repeat, compared to the normal situation, the tax rate on the inputs is higher compared to the tax rate on the output. What is the meaning of it? Let's start with a very simple example. Imagine I'm manufacturing this stylus or a marker, doesn't matter. I will purchase certain inputs, raw materials, and let's say on the raw materials, the GST rate applicable is 18%. I will use the raw material, manufacture the stylus, sell it to you, and now on the final product or on the sale of this product, the GST rate applicable is 5%. So whenever on the inputs, the tax rate is applicable is higher compared to the tax rate on the output, this situation is called as inverted duty structure. Although I am talking about inverted duty structure in the context of GST, in the context of good produced in India, you can apply the same logic whenever you import as well. That is, understand the logic here. I am explaining this because some of you will assume that inverted duty structure will always be associated with only GST. You will simply restrict it to only GST. Absolutely no. For example, same one. I will import this particular marker or let's say stylus from rest of the world. Government will impose an import duty of 5%. And another manufacturer will import a raw material to manufacture the marker. First case, I will import the final product. 5% is the tax rate. Another manufacturer will import raw material. Government will impose 18% tax rate on it. So don't you think in that case also there is an inverted duty structure? Which basically means, in the second example I am talking about here, rather than importing raw material and manufacturing, where I am paying 18%, it makes more sense for me to import a final product. That is, import at a lower tax rate. So remember that concept as well. IDS, inverted duty structure, is applicable even in case of imports as well. Now come back to the discussion here. Electronic vehicle manufacturers or electric vehicle manufacturers, EV manufacturers, two-wheelers and three-wheelers, they are complaining that on some of the components that they purchase, the GST rate is 12% and 18%. For some of them it is 12 and some of them it is 18%. And when they will manufacture this electric vehicle and sell it to a customer, GST rate applicable is 5%, which is nothing but inverted duty structure. And some of you might be thinking, what is the problem? Let there be inverted duty structure. What is the issue? What is the concern here? Concern is, I am supposed to get the duty credit. That is, whatever taxes I am paying here, not specifically duty credit, input tax credit. Whatever taxes I pay on the inputs, I am supposed to get input tax credit. So if the tax rate is higher, which basically means lot of my money, that is my working capital, lot of my working capital is there with the government and I'll have to wait till I get the input tax credit. So lot of working capital will get stuck up, and this the working capital as such for various manufacturers, small manufacturers, micro enterprises, this working capital as such is always in shortage. And in case of inverted duty structure, more of this working capital will get stuck up with the government until and unless I get ITC. So we need to address this issue of the inverted duty structure. That is the first concern. Second concern is this one. The EV makers in bind as a subsidy portal yet to get off the ground. Now what is the issue here? What is the argument? Government of India earlier had FAME 1, FAME 2 initiative. And from the 1st of April 2024, Government of India and specifically Ministry of Heavy Industries, MHI, Ministry of Heavy Industries announced a new initiative to be implemented, that is Electric Mobility Promotion Scheme, EMPS. Under Electric Mobility Promotion Scheme, the allocation of the funds is 500 crore rupees, but the electric two-wheelers and three-wheeler manufacturers, if they wanted to get the subsidy under this, scheme, they were supposed to be registered under a portal. They were supposed to take a certification under a portal. And although it has been the 1st of April, 2nd of April, these manufacturers of two-wheelers and three-wheeler electric vehicles, they have approached the government of India and they have told them, since there is no portal which is operational, I am not able to register myself. And if I am not registering myself, you will not give me subsidy. And if you do not give me subsidy, now I will not be able to sell the vehicle to the customer at lower prices. And that is the reason by evening of 2nd April, this is updation here, right? This article came on the 1st of April. So from the evening of 2nd April evening, the officials from the Ministry of Heavy Industries have started issuing hard copies of certificates. Hard copies. Portal is not yet operational. So instead of registering on the portal, now the same process they are doing in manual process. Manually they are doing it, and hard copies are being issued to the electric two-wheeler and three-wheeler manufacturers under EMPS initiative. So this is the second article related to the electric vehicle manufacturing, which was there in the last 1 week. Let me go to the next article. Reserve Bank of India to revert to multiple price auction. MPA. I'll start using the term MPA, multiple price auction. Now, whenever you talk about Reserve Bank of India, one function that RBI performs and excels at is basically conducting auctions for government securities. RBI conducts auctions for government securities and sells the government securities through the process, collects the money and transfers, gives it to government, helps the government of India to borrow from the market. Now, until 2021, until July 2021, whenever RBI conducted auctions of these government securities, please understand, you will come across two terminologies. One is multiple price auction and the second one is uniform price auction. Multiple price auction, MPA, and the second one will be uniform price auction, UPA. So until 2021, the RBI used to follow a concept of multiple price auctions. And from July 2021, we shifted to a concept called as a uniform price auction for some of the government securities, and for remaining government securities, we continued with MPA itself. I'll tell you what is MPA and UPA, don't worry, I'll explain that. The basic argument was for ultra long securities, ultra long duration securities, Reserve Bank of India continued with the concept of MPA itself. And what do you mean by ultra long duration securities? Those securities which will have a maturity period, which will have a tenure of 30 years and above. 30 years and above. For example, 30 years, 40 years. Now, before I go forward, what is the duration or what is the maximum duration of a government bond which has been issued by Government of India so far? I'm asking this question because in the last year, there is a new series of government bonds which have been issued by Government of India with the highest tenure right now. What is the answer to that? Is it 30 years? Is it just 40 years? Or is it 45? Is it 50? What is the right answer? Please do let me know in the comment section. So ultra long securities or ultra long duration securities such as 30 years, 40 years, etc. These were continued to be conducted or sold, auctioned under MPA, multiple price auctions, and other government securities of duration 2 years to 14 years. 2 years to 14 years, 2 years to 14 years were continued to be auctioned under the concept of UPA. And very recently, Reserve Bank of India has stated that starting 1st of April 2024, and some of you might be wondering, sir, why? Why do we always target 1st of April 2024 for many of these initiatives? For example, earlier also you said EMPS will be launched, will be implemented from 1st of April 2024. Now RBI is also saying they will revert to the idea of MPA from 1st of April 2024. What is the whole idea? Why 1st of April is a important date? Reason is very simple. 1st April of every year will be the starting date for a new financial year. That is the day from which the new fiscal will start, and that's the reason generally the 1st April will be the starting date for many initiatives. Now coming to the point here, why has RBI announced that instead of having two systems, that is MPA for more than 30 years or more than 30-year government securities and UPA for other government securities, government bonds essentially, why instead of having two systems, they will revert back to only one system, that is a multiple price auction. But before that, what is multiple price auction and what is uniform price auction? Now let's say Reserve Bank of India is conducting an auction and there are a lot of government bonds which they are supposed to sell, that is auction to the buyers or investors in the market. Now understand this, if RBI will decide this is the cutoff price, let's say cutoff price is 100 rupees, you might have given a price of let's say 102 rupees, or your friend would have bid for a price of 103 rupees, somebody else would have bid for a price of 101. So RBI, understand this, under uniform price auction, under UPA, uniform price auction, if the cutoff price is 100 rupees, whatever be the bid pricing, the bonds will be allocated to you at 100 rupees only. Is the logic okay? I'll repeat it again. Under uniform price auctioning, whatever may be the bid price above the cutoff price, the RBI will allocate the bonds only at the cutoff price itself. This is called as a uniform price auction. And from 2021, for these bonds, that is the bonds with maturity period of 2 years to 14 years, the Reserve Bank of India introduced a UPA. The logic was simple. Reserve Bank of India was concerned that many of the participants in the market, many of the investors in the market were not quoting the prices correctly. The prices that they were bidding had no connection to the secondary market prices. So a lot of volatility was there, lot of devolvement of the issuance was there. So RBI said, let me introduce the concept of UPA, uniform price auctioning, where I'll take the cutoff price and any price that you basically quote after that, I will allocate it at the uniform price itself. That is UPA. What about MPA? In case of MPA, RBI says, whatever price that you are quoting at or whatever price you are bidding at, I will allocate it to you at the same price. That is generally the argument here is, under MPA, if lot of these investors are exuberant enough, they'll simply want to ensure that they want to purchase a bond, they'll simply quote it at 110 rupees. Under UPA, of course the cutoff price will be much lower, but they will be allocated with the bond because they have basically quoted, they have basically priced a bond, they have demanded a bond at a much higher price. So there were a lot of exuberance, right? The prices that they were quoting were very high. So now RBI says, okay, in that situation, what I will simply do is, I will introduce MPA, multiple price auction, wherein if you quote 110 and the cutoff is 100 rupees, now I will allocate the bond to you at 110 rupees, not at 100. I will allocate it at whatever price you have bid, which is above the cutoff price. This is basically concept of multiple price auctioning. RBI simply says, if the investors are not participating considering the secondary market prices, they are not quoting the right price, they are simply quoting very high price just to get the bonds allocated, then let me sell the bonds at their quoted price itself. That is basically the MPA system, multiple price auctioning. So starting 1st April 2024, now have a look at this. RBI simply says we will revert back to multiple price auctions. Let me go to the last article for the day. SEBI updates complaint redressal site for investors. SEBI is addressing the complaint redressal site. And what is a complaint redressal site? It is called as SCORES. SCORES. SEBI is complaint redressal system. SEBI's complaint redressal system, scores. The idea for scores was implemented by SEBI back in the year 2011. And thereafter, scores has been there in the discussion for multiple years now. Couple of years ago, even in the budget that was announced by Government of India, the Union budget, they mentioned that we will be promoting this model of a scores system where any investor, they have a grievance, they have got a complaint against any authority or any institution, to be very precise, any institution, any company which is regulated by SEBI, they can always go to scores platform and file a complaint. Redressal system will be there. And the SEBI, the market regulator, later came out with investment protection charter. Investment protection charter. Under the investment protection charter as well, the SEBI started promoting the model or the platform of scores system. Now what has been done very recently, just factual information here, SEBI now says we are going to roll out the second iteration, that is scores 2.0 will be launched. From 1st of April, it has already been launched. A new platform has been set up. And what is the benefit of the new platform? What are the features of the new platform compared to earlier system? This is a flow chart, you can just have a look at it. Compared to earlier system, where the time limit that was prescribed under the scores platform was 30 days, now the time limit has been reduced to 21 calendar days. And there are multiple review systems, two-step review system, where if the resolution is not provided, if the resolution is not done within the specified period of time, auto escalation will take place. So the features of the systems are very simple, right? Efficient, the system will promote efficiency through auto routing of the complaints to respective authorities, auto escalation in case the time limits are not adhered to, monitoring by the designated bodies, etc. So the time limit has been reduced, auto escalation system has been introduced, directly the complaints will be routed to respective authorities, etc. These are certain very important features of the scores 2.0 platform, which will make it much more efficient, or it will enhance the resolution of the complaints filed by the investors regarding entities which will come under the SEBI's regulation. So these are certain very important points regarding scores 2.0. So these are the various articles as well as the concepts related to the articles along with the questions that we have taken up in this week. If you like this initiative, please hit the like button. Provide your valuable comments in the section below, and if you are yet to subscribe to our YouTube channel, kindly do it now. Thank you. Have a great day.